Okay, so in this episode, I am here with my good friend Ty Coleman. Ty is a mortgage broker, and he's going to tell us how mortgage brokers decide whether you should get a house or not. And it's going to be really interesting. Full disclosure, I, I said Ty's a good friend. We attend the same church. We're the same small group at church. I mean, so I've known him for a long time, and he's agreed to come on and tell us what he sees behind pull back the curtain and help us see. So Ty, thank you for coming on the show.
No problem.
You are listening to The Leadersmith, Darren Gertis.
No problem, Darren. Nice to see you.
Hey, so Ty, tell the audience where you work, and so what exactly you do as a mortgage broker and where.
Yes, so I'm in South Carolina, and I'm a mortgage broker for Premier Nationwide Lending, or also loan officer. And I am that guy that ultimately says you're approved or you're denied.
Okay, but tell us how you get to that part. Like, what exactly do you do? You don't go in the back and roll dice. You systematically look through certain things, and with the paperwork that's generated, and they either are or they aren't, right?
Right. Yep. So I will typically go through your work history, employment history there, and see how consistent your work is. And then also I'm going to go through your credit to see what your credit worthiness is. And I'm going to go through income documents to see how much you make per month and per year. And then also I'm going to really look at how much you have in the bank. How much have you been able to save over periods of time? And if you have money to put down or for closing costs, all those things are important.
So are you looking to deny people, or are you looking to loan to them? Like what is your default setting? You want to do X, which is it?
Mhm. I want them to get a loan.
Okay.
That is my desire. But of course, we have regulations. So we don't want to give a loan to someone that's going to foreclose
Yeah.
within a year or something like that.
And that makes perfect sense. Okay,
Right.
so I asked you to sketch out the top 10 reasons that people are denied. So you're going to go from 10 to 1. I'm sure there's more than 10 reasons, but we're going from the least important to the most important. So when we get to 1, that's the most important reason. But the least of the top 10 is what? Okay, the reasons that they are going to be denied for a loan.
Okay, so number 10 would be putting cash in your bank account all of a sudden.
Why?
The reason why you don't want to do that is because there's a requirement of having your bank account seasoned for at least 2 months. If you throw some cash in there all of a sudden, now we're looking at that's a red flag, and we're looking at, all right, is there some kind of money laundering going on and things like that? We have all these checklists that we have to check off according to the Patriot Act. So throwing money in there could be a red flag. And so we want to make sure that it's seasoned at least over 2 months.
So 2 months seems kind of an arbitrary thing. So that's a government regulation of 2 months,
Yeah.
or that's your rule?
That's the government regulation.
Okay. So, yeah. So, I mean, theoretically, they could have just had their money under their mattress, right?
Yeah. Yeah.
But the government's going, or the lawmakers that decided on this have said, yeah, it's probably not right. They probably would keep their money in the bank, and so maybe it's some funny business. And so, is it about, like you said, Patriot Act? Are they worried about terrorists from the Middle East, or are they?
Well, that's part of it. I know that seems a little crazy for the average Joe getting a loan for a mortgage, but
It seems more. It seems more like they're
happen.
trying to trick the system rather than that they're terrorists.
Yeah, right. Yeah.
Okay, so that was number 10, putting
Yes.
cash in all of a sudden. Number 9.
All right, so number 9, changing your job in the middle of the process.
Why?
Because that can push things back. So So if you were to change your job in the middle of the process, we're going to have to see evidence that you're making just as much or more than what you were making before.
Okay.
Um, so so we're going to have at least two pay stubs, sometimes three, because your first week on a first week or 2 weeks on a job, you may have less hours than you would your normal paycheck. So you might not make 40 hours that week or something like that.
Sure.
So sometimes it'll go up to three paychecks that we'll need to be able to make sure that you're making the same amount.
So that could push the process back, like, move it back a month or something along those lines, or is that
Yes.
okay? So what if they're going to another job that is, the better pay, or what? I mean, is it just bad to change jobs during this time, or is it
It-
is it only if we just can't substantiate it?
if we can't substantiate it, pretty much, because we need to see a work history in the same field. That's
Uh-huh.
part of that job history that we need to see. So if you go from a custodian to an accountant, those aren't going to be really related,
Right.
and we kind of that'll throw off the whole deal. But if you go from an accountant with one company and you change to an accountant with another company, well, we're still good, but now we're going to have to just wait a little bit to see the
Right.
checks come through.
So if I'm hearing you correctly, either way it complicates it, but it could be really it could scuttle it. I mean, it could destroy the process, right?
Right. And remember, you have a seller of a property that is waiting for you. So,
Yeah, that's right. We're thinking about the person getting the loan. We're forgetting about the person on the other side of the equation who wants out. And I mean,
right.
it's costing them money every month in the
Exactly.
process. Okay, I mean, that's a good point. I hadn't even thought of that. Okay, number 8.
Yes. Okay. So, not enough money to cover transaction costs. Okay.
Okay.
Initially, you would think that is maybe a number one issue. The reason why it's later on down this list is because there are ways to get this transaction cost. If you are if you don't have enough down payment, there are some loan programs that will assist you with down payment.
Like what?
Uh, so, and here in South Carolina, we have what we call the state housing program, which is $8,000 down payment assistance, and then we have one called Palmetto Home Advantage, which is it can cover 4 or 5% of your down payment.
Right.
So you'll have those kind of things to help cover that transaction cost.
Okay, so they're like first-time buyers and ones for teachers and things along those lines, right?
Yes, yep, and that one you mentioned for teachers is called Palmetto Heroes. That's a loan program that happens seasonally.
Mhm.
Um, I believe it's a grant program where there's some money put in, and then once that money runs out, then it fills back up for the next year. So
Gotcha.
so yeah, it's pretty seasonal. It comes and goes.
Okay, so uh, yeah, so we don't want to put in cash all of a sudden. We don't want to change jobs. We want to make sure that we have enough money, but there's ways around it, and the ways around it, so that's good.
Mhm.
Number 7, what's the seventh sin?
Okay, so debt to income being the debt to income ratio being too high.
What
Okay,
does that mean? Explain
right.
that, because
So basically, most loan programs you need 45%. You can't go over 45% of your income being taken up by debt. Okay, so we want to make sure that the debt that you have overall, that's including the potential house that you're going to buy, is going to be 45% or under that debt to income ratio. So that's what we're looking at. And um, so if you do USDA, then it's 43%. So it's a little bit stricter guidelines there. But we want to make sure that you're not going to be house poor. That if something happens, well, if you're out of work for a few weeks, that you're not so strapped with your debt that you can't make your mortgage payment.
okay, so using round numbers, if you make $100,000, then you don't want to have debts of more than $45,000. And I mean,
Yeah, over.
in your mortgage payments, is it just
Right.
mortgage payments or is it all debt?
It's
Like,
all debt.
okay, so
Yep.
what other things constitute debt?
Your credit cards, your auto payments,
Okay.
student loans, all those kind of things. Any kind of installment loan or um, revolving loan, which is your credit cards. If you have lines of credit open, those are all counted as your debt.
And so this is why we have so much paperwork generated
Yeah.
on your
Yes.
end because we're trying to. Yeah, okay, I got you. Okay, so we don't want debt to be too high. How about
Right.
number six? What's a
Number
sixth?
6. Okay. Lies and surprises in your paperwork. Okay. Now, obviously, if you were not aware of some things, maybe there's a debt that you have out. I'll just give an example of one loan that I had. I won't say any names, but there is. I had a guy who he was going for a VA loan, and he had a loan from 1993 with the Small Business Administration, and he didn't realize that he even had that loan out. Um, and apparently, his wife had taken that loan out for him when they had some damage with their prior home years ago and back then. Well, anyway, he still owed that debt, and it came up in our research. So he had to pay that off, but he didn't realize that was the case. So he had the funds to pay it off, so he was able to pay it off. Some people don't have the funds to pay debt like that off, and then it ends up crashing the whole deal.
Okay, so that for in this case, it was an honest mistake. Have you seen other
Yes.
surprises that were like intentionally deceptive?
Yes, I've had people try to commit mortgage fraud, and we weren't able to get insurance on the house that he was trying to purchase, and that just didn't go over well, obviously.
So I
And
think I know what mortgage fraud is, but explain that to the
well,
audience.
I'll just say mortgage fraud. Basically, one of the ways that you can commit mortgage fraud is say that you're living in a house,
Hmm.
it is your primary residence, and then when it's actually an investment property.
Okay.
And if you use that investment property as a primary residence, you're pretty much trying to cheat the system with taxes and things like that. So
Gotcha.
so when you go and live in another property, uh, as that also is a primary residence, now you have two primary residents uh, in which you're saying that you're living in most of the time, which is impossible. So that is one way of committing mortgage fraud. Another way is maybe having other people live in a house that you're paying on, or you're paying on, but you're not actually living there. Things like that. Um, it, those are ways that you can commit mortgage fraud.
Okay, so it turns out the government doesn't like when you commit fraud.
Exactly.
Yeah. Okay. So you told me about lies and surprises. What other surprises might be there?
So one of the surprises is that you can have more income flowing through the house. Okay, and if you're in um, a household income-based loan program, then if you're over the income limit for that program, that can throw off that deal.
Okay.
Um, and that includes anybody that works in the house. That could be a teenager that's working. And
Wow. Yeah. Okay. So this
so
is like
so
an incentive program to help people get, the first home or something, and then, you overqualify, so you no longer qualify, or you have a higher income,
exactly.
and so you no longer qualify for that program. Is that what you're saying?
Right.
Gotcha.
Exactly. Yeah. So those are one of those surprises that can happen.
Okay, number five, the fifth most important issue to avoid.
Okay. So we mentioned this a little bit earlier, but it's the mortgage fraud with um, the second residence.
Okay.
So again, that is one that is just really something that when I had that when I had that kind of deal happen, um, it squashed it right away.
Yeah. Okay.
Soon as we tried to get insurance, that insurance, we couldn't get insurance on the house they was trying to purchase, and the reason why is because he already had insurance claimed out on another property and everything.
Right. And the system will flag that kind of thing, right?
Exactly.
Yeah. Okay.
So so then we had to stop that deal. And honestly, if I knew that and went ahead with it, then it's possible that I can get in trouble for that. So
Yeah, and that makes sense, right? We don't
yeah,
want you committing fraud either. So you have to be an
exactly.
honest broker here. Okay, number 4.
Number four, so default on government student loans. Okay, a default on government student loan will kill a deal right away. The government wants their money. They don't want you to hold back on your student loans. Uh, that will just end it right there.
Why? Why student loans as opposed to other things like you can run your credit cards all day.
Yep, it's because it's the government. um,
Okay.
yeah, if it's any government debt that you default on, it will squash the deal.
Okay.
And it's just a rule for specifically for government loans. If you are, maybe if you have student loans that are in deferment, that's fine. But under certain loan programs, we might have to count the student loan debt at 1% per month.
Okay.
That you're paying against your debt to income ratio. But if any of those government loans are in default, um, that's the end of that. We're going to stop there until you get that in order.
Now you use the word deferment, and as a professor, I understand that, but people listening might not understand what deferment is. Can you explain that?
Yeah. So basically, deferment is when you are, we'll say, deferring your monthly payments for a later time. So you're basically, I guess you can say, holding off your monthly payments for a later time. Uh, as of when we went into COVID, everyone's student loans went to deferment uh,
Mhm.
as far as part of the government pretty much standard there. Um, and then when they come out of deferment, then you have to make those payments again
Right.
to continue on. All right.
Yeah, it's funny because as a professor, my thinking goes like this. Oh, if you go back and get your master's degree, and by the way, I can help you with that with getting your master's degree in business or leadership or whatever, you immediately go into deferment, right? So you're no longer paying on
Yep.
those student loans. You're actually in our program. So until you're done with our program, your student loan payment stops. And then you pay on the other side. And
Yeah.
the government's trying to incentivize certain things, and that's what he's talking about. Okay,
Yeah.
so
Well, can I add one more thing to that, because you brought up
sure, go ahead.
a question in my mind is that um, if you are in school, right, can you still buy a house because they're on deferment? Or do we still have to count it at 1% if you're in deferment? Um, the answer is you can still buy a house. And we don't necessarily have to count it at 1% if you're in deferment, if you have a letter saying what your payments are going to be when you start back up your payments.
You're like a freaking encyclopedia on this stuff. Wow. Okay, well, that's good. I mean, I guess that's really good since this is your business. Okay, number
Mhm.
3.
Yes. All right. Consistent work history. We touched on that a little bit. I want to go in a little bit more detail about that.
Okay,
Consistent work history, um, or well, I'll say inconsistent work history is something that can, get you denied.
let's start that one again.
Okay, yeah. So inconsistent work history is something that can get you denied, but I want to go into that a little bit more. All right. So what we're looking for is at least 2 years work history in the same field, at least. Okay.
Okay.
It's better if you're on the same job, but we understand if you are going to get paid on another job a little bit better, or you have better benefits, that's the explanation that we can put in there, and we will be able to, see the difference there. Um, when we do your what we call verification of employment, we'll be able to see the difference of your pay. Or if you have better benefits somewhere else, I mean, that's definitely a reason to move to another job.
So if you move, if I'm hearing you correctly, if you move to a better job and it's clear that it's moving to a better job, not just got mad and left, but
Right.
you went to something better, then it counts toward your 2 years of that you're in that position.
Yes, but
Okay,
here's the
that makes
thing,
sense. I
it's
never knew that.
still
That's interesting.
yep. And here's the thing, it has to be according to the field that you were previously in now.
Okay.
Because if you go to another job and you're trying out a different kind of field, you might not like that field, and you might end up quitting that field and going back to something else that pays less. So we have to go off of a little bit more history, to make sure that, all right, this is at least a field that he or she is used to or likes and has been in it, has been established in there for a little, at least 2 years. Um, those are key. And then I also want to say, if you've gone to school and you got a job in the field that you went to school in, your time in school also counts
Oh,
to
really?
work history. All right.
Wow.
You would need to get your transcripts to make sure that, for that paper trail. But yeah, that counts towards your work history.
Okay, so that makes sense. I'm trying to understand why you have to stay in the field rather than just working. I mean, like, what's
Mhm.
what's the real like? It seems like it kind of locks you into a particular path, but I guess
Mhm.
that gives the bank some comfort.
It does. It does give the bank some comfort. It uh, basically, if you have a doctor, that's going to perform surgery on you, but last year he was a I don't know, construction worker with no background history, you probably don't want that doctor performing.
No, I don't.
Yeah, so we want to make sure that you're going to pay your mortgage. So we don't want to see inconsistent work history where you're jumping from one job to another,
Okay.
and it's hard to trust that.
Yeah, yeah, I understand. Okay, the number two, second most important reason. What do you say?
Negative items on your credit.
Okay.
Um, Depending on how recent these items are on your credit, and depending on the loan type, um, that could stop a deal, kill the deal right there. Okay.
Hmm.
So if we have, let's say you have a collection that is less than a year old, you're going to have to satisfy that collection before moving on. If it's a really high debt, like a large balance on whatever that account is, and you can't pay it, then we're waiting for a while, maybe 2 years or so before you're able to purchase a house. Or if you find the money to pay that debt off, then go ahead and pay that off. So those items, those negative items, really impact um, your ability to buy.
Okay. Well, and yeah, that makes sense. I mean, like, if I was the bank, I'd be a little nervous about that kind of thing too. If I saw these negative items. Okay. And then number one was, it sounds similar. Low credit score. You said when we
Yes.
first talked about it, right? I said like,
Mhm.
what's the thing that really holds you back? Is that your
Mhm.
number one?
Yes. Number one is a low credit score. If your credit score doesn't meet the requirements of the loan, we stop there.
Okay. Now you were a credit counselor in a previous
Yes.
iteration before this is a really interesting combination. Before you
Mhm.
became a mortgage broker, you were a credit counselor. So tell us all about
Yes.
how the credit score thing works.
Okay. Yeah. So when you in your credit score, um, you have a certain percentage of your credit score that's calculated for your work history. I mean your credit history. You have a new credit category, and so on and so forth. You have a bunch of different categories going on there, and what the way your credit score is calculated is according to basically your good credit, how you are able to pay your bills. Um, if you establish new credit, sometimes that can be good, but if you have a bunch of inquiries on your credit report, that could be bad. Um, so that can actually bring your credit score down.
How do you get these inquiries?
Okay, yep. You get the inquiries by when you apply for a loan. Uh,
Okay.
for any type of loan or apply for a credit card, any of those things, that's how you get them. And if you're going around from, let's say, car dealership to car dealership over and over again asking for money, then that ends up negatively affecting your credit score over time. That's in a new credit category, which is 10% of your credit score. Okay, so what you want to do is you want to limit your inquiries. You want to make sure you pay all your bills on time.
Mhm.
You want to have your balances low. That's another big thing. You want to have your balances low. So if you have a credit card on a revolving credit, you want to make sure that the balance is low and basically under 30% of your credit limit. That's where it really helps you, 30% or under. So you want to make sure your balance is low, and that way you're not using all of your limit. You have some backup there.
So if you have a lot of credit cards, you want to close some of them, right?
No, you don't want to close them
Why?
now, because when you close credit cards, that'll give you an immediate drop because you lost credit. I know.
Okay, well, I'm glad I asked.
Yeah. So you don't want to close them. Now you might want to get them down to zero or get them close to zero.
And just not use them?
And yeah, you don't have to
Okay.
use them over a period of time. However, if you don't use them for too long, the creditor will close them, and then your credit score will go down for
Huh.
a period of time. So it's tricky. You got to be able to use it correctly. So once you
Right.
get a credit card, you want to keep it open, but you want to use it correctly. For instance, there was a time where I had to build up my credit, and I used credit cards to help me build that up. So I had 2 credit cards, and I kept the balances low, and that helped me build up credit because I didn't have a large usage of my credit,
Sure.
but I was still using it. And now I just use it about every 3 months just to keep the credit card open.
Gotcha.
So that's the way I do it now.
All right. So those are the top 10 reasons, and we just went through them. But this podcast is all about leadership. So why are we talking to a mortgage broker? So here's what I want to do. Um, what do you see in the paperwork that the rest of us just don't see? Like, I mean, everything you described, like, is it pretty, does it jump out at you and go, "Well, yeah, this person's not getting a loan," or yeah, this person's going to be a pretty good risk unless there's something I really just can't see? How do you, like, do you have a feel for it right away?
Yeah, you kind of do. I mean, once you start to dive into paperwork, it's kind of like you kind of get a good understanding. So we can see your spending habits because we'll pull bank statements. We'll see your spending habits. Are you someone that overdrafts their account a lot? That's not. That's probably not going to work if we see a whole lot of overdrafts in your account. Um, and that, character-wise, that kind of lets me know that you might be an impulse buyer, and you're not afraid to to take out more money than you have. Okay, which ends up being very dangerous financially, and
Sure.
where you might not be able to pay your mortgage.
Yeah.
Or with the credit, a lot of times I'll see some things in credit, and it's like, well, you're not, if you're not paying your bills on time, and I see a lot of late payments. Well, are you going to pay your mortgage on time? Those are the things that we look for, and you got to be able to, I'll say, lead yourself well, to be able to get a mortgage.
Yeah, so that leads me to my next question. So what drives the process of who's successful and not? It sounds like you're talking about choice and effect. Is there a conspiracy to keep people from owning homes? I mean, are the bankers just, we don't want to let those people in?
Oh
Is that what's
no,
going
not at
on?
all. No, it's really the person's behavior,
Okay.
money. So yeah, if there is a person that is, I made the money, I'm going to spend it right away, you're probably going to end up in a situation where you can't afford to purchase a house or anything like that, or bigger items, because you spend it too quickly. You don't have any savings, and you won't have good credit because you're probably not going to be able to keep up with your payments. And also, your debt to income ratio is probably going to be really high um,
Mhm.
if you are taking out a whole lot of credit so you can impulse buy and get what you want right here and right now. That patience is key when you want to build your credit up.
Okay, gotcha. Now we're about out of time, but if you're willing to extend the conversation, I'd like you to come back and tell the audience how to fix bad credit because you have that credit counselor history, right?
Yeah.
Like, so if you can do that, I'd appreciate that. Now, you told me, now this is quite a claim. You told me that you
Mhm.
can fix just about anybody's credit, which I
Mhm.
find pretty remarkable. And that with most people, you could do it within a year, like get them into that home if they just do what you say.
Yes, yes.
Okay. Now that's
Sure.
I'm sure there's an outlier there, but in general, I mean, if you can do that, that's pretty remarkable. So first, before we end, tell people how they can get a hold of you. Like if they wanted to talk to you as opposed to any other mortgage broker after hearing this,
Mhm.
how do they get a hold of you?
Yep. You can I'll give you my email address. You can email me at T Coleman. It's TCOLEMAN at P as in Premier, N as in Nationwide, and then the word lending, LENDING.com.
Okay.
That's my email. And then also my work number is 610 And that is the way that you can get in touch with me. If you want to apply, you can go to tyronecoleman.com and you can apply for a mortgage there. And I would be happy to assist you with.
Well, thank you for making yourself available to people in the audience.
Mhm.
Okay, well, Ty, thank you for coming on the program and providing us all that information, peeking behind the curtain, and letting us know like this is how like they really do. The bankers really do want to lend the loans, but they have to be sure that they're going to get their money back. I mean, is that a
Yes,
pretty fair summary?
yes, that is.
Okay, so in the next episode, we're going to talk about what to do if you need to fix your credit, and you're going to lay it all out just like you did here, right?
Yes, I
All
will be
right.
happy to.
We'll see you in the next episode.
All right, see ya.